Welcome to The Explainer. Today, we are diving into something huge, Canada's massive 2026 property tax shakeup. And listen, if you own any property at all, you really need to pay attention to this one. The stakes are incredibly high, and honestly, these changes could get very, very expensive.
So let's just cut right to the chase with a big question on everyone's mind. Could these new taxes actually cost you something like $40,000 a year? We're talking about a potential nightmare scenario here for some property owners. And get this, that's on top of your regular property taxes.
Yeah, you heard that right. $40,000. That is not a typo. We're talking about the potential annual cost for, say, $1 million property, and that's just from one set of these new rules. It's an absolutely massive hit. I mean, it could make owning certain properties just devastatingly expensive.
All right, Section 1, the 2026 tax shakeup. So, what's actually going on here? Well, the federal and provincial governments are rolling out a whole new playbook of tax rules, and these are going to affect pretty much everyone. Homeowners, investors, landlords, you name it, right across the country.
And these aren't just little tweaks, the changes are sweeping. They're creating brand new tax traps and really tightening up the rules that, honestly, millions of Canadians have counted on for decades to build their wealth. Okay, let's get into the details. Section 2, the new vacancy taxes. This is the first major change, and frankly, it's the one causing the most concern. We're talking about new and expanded taxes on properties that the government decides are vacant or underused. The idea being that this will help with the housing supply crisis.
So the big one here is the Federal Underused Housing Tax, or UHT for short. It's actually pretty simple in a scary way. If your property is lived in for less than 180 days a year, yep, that's just 6 months, you could be on the hook for this tax.
But here's where it gets really tricky. We're not just talking about one tax. Nope, you've got the federal UHT, which applies nationwide. And now you've got big cities like Vancouver and Toronto jumping in and adding their own vacant home taxes right on top.
So first up, you could get dinged with that 1% federal underused housing tax. That's 1% of your property's total value.
And then you have to add the city's tax. In a place like Vancouver, that tax has already shot up to as high as 3%.
Let's just think about that for a second. A 3% tax from the city on $1 million property? That's $30,000 by itself. And we haven't even gotten to the federal tax yet. And bam, this is how we get to that nightmare scenario. These taxes stack up one on top of the other. That could mean a total tax of 4% of your property's value every single year. And on that $1 million home we mentioned, that's the $40,000 bill we talked about right at the start.
All right, let's shift gears. Section 3, changes when you sell. It's not just about holding property, it's also about what happens when you decide to sell. There are some major changes coming to how capital gains are taxed. And you're about to see that even your main home, your principal residence, isn't completely safe from this.
Okay, so the key thing to understand here is the inclusion rate. That's how much of your profit you actually have to pay tax on. For years, it's been a simple 50%. But now, for any gains over $250,000, that rate is jumping up to 2/3. Just look at the example here. On an $800,000 gain, that means over $91,000 more dollars gets counted as taxable income. Wow, this really hits long-term investors the hardest. I mean, it completely changes the math on a retirement nest egg you've been counting on for decades.
For most of us, our home is our biggest asset, right? And that profit when you sell has always been tax-free. It's called the principal residence exemption, and it's practically sacred in Canadian tax law. But even this cornerstone is getting some new tripwires. Now you've got to file specific forms on time, no excuses. And if you've used part of your home for a business or a rental, a chunk of your profit could suddenly become taxable. On top of that, the CRA is cracking down hard on what they call flipping. And if they reclassify your sale, your entire profit could be taxed as business income.
Okay, on to Section 4, new rules for landlords. So if you're a landlord, listen up. The government's got new rules coming just for you, and it's all about much stricter reporting and putting new limits on the expenses you can claim.
So the days of just lumping all your rental finances into one pot, they're over, gone. Now you have to report your income and expenses for each individual property. And let's say you have a cottage you rent out but also use yourself. Well, you can only claim expenses for the time it was actually rented. The big takeaway here is the paperwork. The administrative burden is just going way up. It's clear the government wants to see exactly what's happening with every single rental unit, and that means sloppy bookkeeping is about to become a very, very expensive mistake.
Okay, so we've talked about all these pretty complex and kind of scary changes. The big question is, what can you actually do about it? Let's get into Section 5, your action plan. Here's a clear, straightforward plan to get you prepared.
It really boils down to these 4 steps. 1. Review everything you own. You've got to understand exactly which of these new rules apply to your specific properties. 2. Make a call on any vacant property. Are you going to rent it, use it for those 180+ days, or just sell it to avoid those nasty taxes? 3. Think about timing your sales. It might make sense to sell some investment properties before these new capital gains rules really kick in. And 4, and this is a big one, get your paperwork in order. Start keeping meticulous records for your home and your rentals, like right now.
So, is your financial future ready for 2026? Look, the time to act on this is now, not in 2026 when these rules are already law. Waiting around is a recipe for a very expensive mistake. The entire Canadian real estate tax landscape is shifting under our feet. And honestly, your financial future really does depend on understanding what's coming and making a plan for it today.